Today we are talking about the daily high-low and the work time indicators as used in the BTMM strategy. So you could be getting stopped out every time you are taking a trade, not knowing you are not dealing in the exact levels where the market makers are actually putting their orders. Still getting stopped out by market makers? These two indicators will literally change that story for good. I would like you to pay me your attention for the next few minutes, as this could be the missing link to your sniper precision. I'll show you exactly how to combine the two indicators, that is the daily high-low and the work time indicators, to find sniper entries and avoid market traps like a pro. So the big question here is, why do you need these indicators together? Now, BTMM trading is all about timing and the key levels in the market. The daily high-low indicator usually shows you where the market makers are likely going to strike, while the work time indicator, on the other hand, shows you exactly when they will strike. Let's get to understand these indicators one by one. Now, the daily high-low, as I said, is where the market makers will trap you. And this is actually the previous day's high or low. Once you mark these key levels, it means that that's where the market found liquidity or volume to push the market or prices up or down. So they are very significant key levels in the market. The daily high-low will actually help you avoid fake breakouts and trade with the exact sniper precision. These horizontal dotted lines that you can see on my chart are what we are calling the daily high-low. And they usually mark the previous day's high and the previous day's low. So for instance, if we wanted to know where exactly was this trading day's high or low, we'll look the following day. This is the previous day's high and this is the previous day's low. In a similar manner, if we wanted to know where was the low of this trading day and its high, here it is. The following day, it's plotted right there for you and down here, right? So in other words, these are key levels where the market was able to push prices or reverse prices, meaning there is some key volume sitting around here. And every time the market comes back here, we expect to see a certain reaction. And based on what we are trading or the buyers in the market, we are going to take a trade based on the structure or the market behavior that we are going to find at those key levels. Number two is the work time indicator. Okay. And the work time indicator is also known as the sessions indicator. It's an indicator that helps you to mark the low and the high of each session. So when the market is moving, it leaves behind a certain trail. If it's London session, where did we find volume to reverse back prices or to push them further? If it's New York session, where did we find the liquidity to push the prices higher or lower? All right. And this is a very significant information when you're trading, because it will help you to know where to actually be looking for setups, right? So when the market makers are moving, they move with time, with sessions, and you must be able to align yourself with the market makers, right? You must be able to time the market. You must be able to time your entries. So this indicator will show you when the market makers will strike. Underline the word when, meaning that there is a time they are going to strike and there is a time they are not interested. So you must be able to align yourself properly to be able to actually catch those good moves and get some good pips out of the market. Here we have the work time indicator, all right? And the whole intention is just so that you can catch those moves before they happen. And that is why you need to pay your attention closely, because I'm about to give you some secrets that probably you've been missing. So Here is the work time indicator. And from this indicator, what we have is sessions, and they are divided. We only trade the 3 major sessions in the market. There are about 5 sessions, but we're only going to focus on 3. So we have the Asian market, which is the blue rectangle you can see. Then we have the London session, and then we have the New York session. Those are the 3 key market sessions that we are going to focus on. Now, the trick here is to be able to identify the high and the low of each session. The high of Asia, the low of Asia, the high of London, right? And the low of London, the high of New York, and the low of New York. All right? That is our key interest, to be able to know where exactly the market is going next or what it's doing. Now, here is the thing. When a session is closed, like here we can see the Asian session is closed, there is volume lying on the upper side and there is volume lying on the lower side. Same for London session. When it is completely closed and we are now moving into New York session, there is liquidity above London session, right? And it's being swept. And there is also liquidity below the London session. Same way, there will be liquidity right above the New York session and right below the New York session. So there is always something happening at these lows and highs. Now, your job is to be able to spot prices in these key zones above and below, not in between. And we don't trade when the market has not given us a structure or met a certain condition. Now, depending on what you're trading, it will determine what these indicators will be telling you to do. Because again, you can be trading everything and every setup. So we all know, if you trade BTMM, we know that the market moves in cycles. We know the market moves in pushes, right? It breathes in, it breathes out. Okay? What do we mean by that? Or rather, what do I mean by that? The market forms what we call a peak formation. It could be a peak formation low, or it could be a peak formation high. And what the market does, once a peak formation low is formed, they will breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, and then they prepare for a reversal. All right. So now here is your peak formation low. Here is your level 1. All right. Here is your level 2. Here is your level 3. And then here is your reversal setup or the peak formation high before the market starts going down. Now, let's assume the market is going up. All right. Now, we want to combine the 2 indicators, right? The 2 indicators to be able to align ourselves with the market as it moves up or as it trends upward. Let's now understand how we are going to combine these 2 indicators, right, to find those sniper trades. Just before the price leaves, we are in the market and in the right direction, right? So number 1, you need to be able to identify the Asian market, all right? The Asian range. So this is the day open. We want to see, after the Asian is closed, we want to see its high, and we also want to see its low. The blue box you see has actually what we call low volume, and it is actually a setup zone, right? It's a setup zone. You need to be very careful what happens, right? Right above it and right below it. Okay? Most importantly, the market makers set traps in here, right? They move down, move up, move down, move up until the session closes. All they are doing is accumulating money. They are accumulating those orders, squeezing in the price together into a small range, right? So you need to see its high and you need to see its low. Now, we go slowly. That's all about Asian market. You do not trade in Asian market. You do not trade. This is the initial low and the high of the day. And it will now guide you what to do once the real volume enters the market. Number 2, you need to mark or identify the previous day's high and low. Okay, the previous day's high and low. And why do you need to do this? Because price will often fake out above or below these levels. Very important for you to understand that these levels is where the market makers will trap you. They will either fake out or pull you in, right? Then go against your intention. All right. So if a breakout happens near a session open, again, listen, if a breakout happens near a session open, be cautious because it could be a trap. Let's assume this is the day open, this is the Asian low and Asian high, then this is the dotted line, meaning the yesterday's high, right? There it is. Okay. So then price, after consolidating in Asian market, all right, just before London opens, let's assume this is the start of London, right? The market pushes, and before it opens, the market breaks out of yesterday's high. You don't want to execute a buy trade here because it means that as London session opens, this could have been a trap so that they can actually move the price down, right? So how do you use the daily high low? Now, the daily high low, once you have it in place, it means that once the price approaches this level, you want to look out for a reversal to the downside because this is a key level. Or you are going to find a continuation trade formed right along this particular level. It's a market maker key level. Okay, so let's assume the market actually is bullish and the market actually breaks out. This daily high low can also be actually in between here. The market can be forming the Asian range right at the yesterday's high or low. And if they are bullish, let's suppose it's this one here, the market is going to issue you with a double bottom. And I mean a double bottom, something like this, right? A double bottom, just like that. And then it is going to continue going up, if that is the trend for the week or the day. But if it was bearish, let's assume it was bearish, it means the market makers will reverse the market, most likely reverse the market right at yesterday's high, right? So they will come and form a setup during London. Okay, so they fake out up, then they form a sell setup just to take the prices down. And that is why you do not take a trade when the market aggressively, right, breaks above yesterday's high or low. However, it's good to note that it's not every time this will work. The market could still be bullish, and so it will break above yesterday's high, give you a setup to enter and continue with the trend. But it's up to you to be able to identify or tell what the market makers are about to do. Anyway, let's get to see how you identify a setup using these two indicators. Now, for an entry, okay, you want the price to break or tap, okay, below previous low during London Open. Then quick reversal back inside the range, okay? And then you're going to look for TDI crossover confirmations. If it's a buy setup or vice versa for a sell setup. Now let's look at that. So let's assume this is the day's open, this is the Asian range, and this is yesterday's high, and this is yesterday's low. Okay, so price breaks below, okay, and then almost immediately reverses back inside, right? It means here something has been grabbed, some money has been sucked or pulled into the market, and the market has reversed almost immediately. Now, if you look at your TDI, you'll most likely have something like this. Well, at the chart, we will have something like this. And this is what we call a divergence. When you see it at the low of yesterday or yesterday's low, then it means the market is actually about to go up or reverse. In the event it was bearish or the price was supposed to probably go down, then this is what will happen. This being the market open, the Asian range right there, market squeezes, right? Market squeezes. And then this is yesterday's high, right? And then the price comes just before London open, price fakes out, forms the first leg and the second leg, like that. Now, this being during London session, it means the price is most likely going to sell. Now, here you see how the price is behaving. It's like it's going down. If you look at the TDI, you will have something like that, meaning that this here, even though it's not above the first leg, on the TDI, it is telling us this is actually the second leg. And that's how you'll be able to catch that trade right at the previous day's high. And you squeeze all the pips you can get from that trade going down. Now, we have seen how to apply the daily high low. But what about the session itself? Let's assume, I actually think we are going to look at the live, charts so that we're able to clearly understand how the market behaves. So in other words, if you haven't been able to understand anything since we started, all we are saying is wait for the price to reach the high or low of previous levels or previous days or previous sessions. Then you will look for rejections or reversal signals, right? Because that is all there is. Those are liquidity levels. Those are liquidity zones where the market, if it taps, we are looking for a reversal to the downside or to the upside, depending on the market structure. So in other words, this is a key level in the market. This is a key level in the market. If the market is bearish, you want to sell from the high. And if the market is bullish, you want to buy from the low. So assuming, because I want to assume that most of you here are trading BTMM strategy. If you're trading the BTMM strategy, then you know the market moves in cycles. So if you have a structure like this, right? You have a structure like that, and the market closes. So I want to assume you have a bullish bias or trend, and this is a peak formation low, all right? Peak formation low. It means you want to buy at the very lowest levels in the market. And those levels in the market could be the low of London, the low of Asian market, or maybe yesterday's low or ADR low, or maybe the 800 or 200 EMA, or maybe something like the psychological levels. Because every time the market is issuing a setup, a certain key level will always be there. It could be a moving average, it could be the low of the day or the low of Asian session, but something will always be there. And we are going to have a look at one or two examples, right? So here is your peak formation low, right? So I'm assuming before this second leg pushes is probably a London session right there. Just before this move happens is London session, right? And then just before this second leg moves is New York Open, right? Something like that, or crossover. So in other words, you have levels to actually be timing. And we want to basically trade only two sessions, London or New York. So let's assume, let me repeat that just so that you are with me. So I want to assume the market is bullish. So we are looking for a buy trade. So let's assume this being the market open, this is the session, Asian session high, Asian session low, right? So the market consolidates, then all of a sudden breaks below the low of the Asian market. So remember, we are buying low. So the low of Asian market becomes our key level. Then the second thing, we get our peak formation low or the double bottom right at the low of Asian market, meaning this is now our confirmation to enter the market. And then I'm assuming this will happen, most likely happens in between London and Asian market, or reversals could also happen in between London and New York. So here we get our peak formation low. We enter the market. The stop loss will go slightly below the structure, and then we are going to ride it. Now, let's assume you missed this entry, but then the market pulls back, most likely to 50 EMA, right? The market pulls back to 50 EMA just before London open, right? So you miss this entry for the first leg, then you can take the EMA, 50 EMA bounce for the trend continuation to level 2 and maybe level 3 before we can have the market come into a dead consolidation. So in other words, we are looking for the low of the session or yesterday's low or any other key level at the bottom where we can buy low and ride the market as it goes up. Now, in the opposite case scenario, let's assume we are bearish or the market is actually going down. This is what happens. Bear with me a minute. So let's assume the market is actually bearish, right? So we have something like this, a big formation high, right? A drop, and then maybe a rise and close, right? And the market closes. So assuming we are trading a bearish market, we want to align ourselves at the highest levels available in the market. And what I mean is those levels could be yesterday's high. It could be the high of London. It could be the high of New York, depending on how the structure will be played out. You can never know how the structure will play out. It is only going to be presented to you as the prices move. So I'm assuming that this is going to be our market open Asian session right there. And then the market consolidates, then breaks out to the top, pushes 3 times, and then gives you this particular pattern right at yesterday's high, something like that. They give you that pattern. And maybe you find that the second leg aligns with the London session. Then it means you execute your sell right there. Stop loss goes right above there. Then you squeeze in those pips as the market goes down. So these are 2 key levels. The market session will help you know when the pattern is going to actually flow, right? While the daily high low helps you to identify or know where the market is going to actually give you that particular setup for continuation to the downside. And this sometimes is hidden. You have to be very tactical to identify those patterns because they are played out in a way that you may not be able to know what exactly is happening in the market. And you're going to see about that. Okay. So let's now walk through how to read the chart when actually both indicators are now active. That was just theory, to just be able to have an idea of what to look for when you're trading in the live markets. So follow me as we actually get to identify setups using those 2 particular indicators.